The power of financial support funding can unlock new opportunities, from starting a business to personal investments or emergencies. Personal funding can be critical in achieving goals when you don't have the cash readily available. Whether you're seeking $10,000 to launch a side hustle or $400,000 for a large project or venture, understanding the landscape of personal loans and funding options is vital. Let's explore the available avenues and strategies for securing the funds you need to fuel your ambitions. Chapter 1. Traditional personal loans overview. Personal loans are one of the most common ways to borrow a fixed sum of money. Banks, credit unions, and online lenders offer personal loans ranging from $1,000 to $400,000, typically without collateral, meaning you don't have to pledge your home, car, or other assets. The loan terms usually span from 1 to 7 years, with interest rates depending on your credit score and loan amount. Key points. 1. Loan amounts, $1,000 to $400,000. 2. Interest rates, typically between 6% to 36%, depending on credit score. 3. Repayment terms, 1 to 7 years. 4. Approval requirements, a good to excellent credit score, income stability, and low debt-to-income ratio. How to get approved. 1. Check your credit score. Your score influences your interest rate. 1. A score above 670 can improve your chances. 2. Compare lenders. Check multiple lenders to find the best rate. 3. Pre-qualify. Many lenders allow pre-qualification without impacting your credit score. 4. Have a clear plan. Lenders want to see that you're using the loan wisely. Chapter 2. Secured personal loans overview. Secured personal loans are an option if you are willing to back your loan with collateral, like a car, property, or savings account. These loans often come with lower interest rates because the lender takes on less risk, but if you default, the lender can seize your asset. Key points. 1. Loan amounts, $5,000 to $400,000. 2. Interest rates, 3% to 25%, depending on the collateral and creditworthiness. 3. Repayment terms, 1 to 10 years. 4. Approval requirements, collateral, good credit, proof of income collateral options. 1. Home equity loan, allows you to borrow against your home's equity. 2. Car title loan, borrow against your vehicle's title. 3. Savings-backed loan, use your savings account as collateral, and you can still earn interest. Chapter 3. Business loans for personal projects overview. If you have a side business or are planning to start one, business loans can be a way to access higher funding amounts, ranging from $25,000 to $400,000. Business loans, lines of credit, and small business administration, SBA, loans can be used for personal projects if connected to your business. Key points. 1. Loan amounts, $10,000 to $400,000. 2. Interest rates, typically 5% to 20%. 3. Repayment terms, 1 to 25 years. 4. Approval requirements, business plan, credit score, business history, if any types of business loans. 1. SBA loans, government-backed loans with favorable terms. 2. Business line of credit, a revolving credit line for flexible spending. 3. Startup loans, designed for new businesses with less than 2 years of history. Chapter 4. Peer-to-peer lending. Peer-to-peer overview. Peer-to-peer lending platforms, such as Lending Club and Prosper, allow individuals to borrow money directly from investors rather than traditional banks. These loans typically have more flexible requirements and may be easier to qualify for if your credit score isn't perfect. Key points. 1. Loan amounts, $1,000 to $50,000. 2. Interest rates, 5% to 36%. 3. Repayment terms, 2 to 5 years. 4. Approval requirements, moderate to good credit score, income verification. How it works. Borrowers apply on a platform, and investors fund all or part bureaucratic hurdles. Chapter 5. Crowdfunding Overview. Crowdfunding platforms like GoFundMe, Kickstarter, or Indiegogo allow individuals to raise funds for personal projects by appealing directly to the public. While these platforms are traditionally used for creative projects, personal finance needs like medical bills or business ventures can also be crowdfunded. Key points. 1. Potential funding amount $1,000 to $400,000 or more, depending on the project. 2. Interest rates, none. 3. Repayment terms, none, although reward-based crowdfunding may require you to deliver a product. Crowdfunding strategies. 1. Tell a compelling story, explain your need and the potential impact of the funds. 2. Create rewards. For reward-based crowdfunding, offer unique items, experiences, or services to backers. 3. Promote your campaign. Use social media and email marketing to reach a broad audience. Chapter 6. Credit cards for short-term funding overview. Credit cards can be a viable solution for smaller funding needs, especially for amounts under $50,000. While not ideal for long-term loans due to high interest rates, credit cards can provide flexibility if used wisely. Key points. 1. Loan amounts $1,000 to $50,000, depending on credit limit. 2. Interest rates 10% to 30% APR. 3. Repayment terms flexible, as long as minimum payments are made. 4. Approval requirements good credit score, low debt to income ratio strategies. 1. 0% introductory APR cards. Some cards offer 0% interest for the first 12 to 18 months, ideal for short-term borrowing. 2. Balance transfer cards. Use these to transfer existing debt to a lower interest card. Chapter 7. Home Equity Line of Credit. HELOC Overview. The HELOC allows you to borrow against the equity in your home. Unlike a lump sum loan, a HELOC functions like a credit card, offering you a line of credit you can draw from as needed, up to your credit limit. Key points. 1. Loan amounts $10,000 to $400,000, depending on home equity. 2. Interest rates 3% to 10%, variable. 3. Repayment terms 10 to 30 years. 4. Approval requirements sufficient home equity, good credit, proof of income. Why it's beneficial. HELOCs typically offer lower interest rates than personal loans because they're secured by your home. This makes them ideal for home renovations or large personal expenses. Chapter 8. Private Lenders and Investors Overview. Private lenders or investors are individuals or companies willing to fund personal projects, especially if they see potential for a return. This type of funding is more common for larger amounts, such as $100,000 to $400,000, and can involve either loans or equity investment. Key points. 1. Loan amounts $50,000 to $400K plus. 2. Interest rates 5% to 20% or equity stake. 3. Repayment terms negotiable, often flexible. 4. Approval requirements solid plan, negotiation skills. How to find private lenders. 1. Networking, attend business and investment events. 2. Pitch platforms, websites like AngelList allow you to pitch to potential investors. 3. Online lending platforms. Some cater specifically to high net worth individuals seeking investment opportunities. Chapter 9. Improving your chances of approval overview. No matter which funding avenue you pursue, there are universal strategies you can employ to improve your chances of securing the funds you need. Key points. 1. Build your credit. Check your credit report and work to improve your score by paying down debt and making timely payments. 2. Have a detailed plan. Lenders want to know how the funds will be used and how you intend to repay them. 3. Limit existing debt. High levels of existing debt can make lenders wary. 4. Offer collateral. If possible, offering collateral can improve your chances and lower interest rates. Conclusion. Finding the right right path to funding. Securing personal funding between $10,000 and $400,000 requires careful planning, research, and strategy. Whether you opt for a traditional personal loan, peer-to-peer lending, or even crowdfunding, understanding your options will help you make the best choice for your financial goals. Always compare rates, terms, and fees to ensure you're getting the best deal possible for your unique needs. Chapter 10. Using retirement accounts for personal funding overview. Retirement accounts like a 401k or an IRA can be tapped into for personal funding, but this should be approached with caution. While these accounts are primarily intended for your retirement, certain situations allow you to withdraw or borrow from them. The key is understanding the risks and benefits, as early withdrawals can lead to significant penalties and taxes. Key points. 1. Loan amounts, $10,000 to $50,000 via 401k loan, or more via early withdrawal. 2. Interest rates, none for withdrawals, but there are tax penalties. 401k loans typically require interest payments back into your account. 3. Repayment terms, 5 years for loans, no repayment for withdrawals, but taxes apply. 4. Approval requirements, must meet specific criteria for early withdrawals. How to access funds. 1. 401k loan, many employers allow you to borrow up to 50% of your vested balance, with a cap of $50,000. 1. These loans must be repaid within 5 years, with interest. 2. IRA early withdrawal, you can withdraw funds before age 59 and a half for specific situations. First-time homebuyer, educational expenses, medical emergencies, without a penalty, though income taxes still apply. 3. Penalty-free 401k withdrawals. Certain situations, like permanent disability, may allow penalty-free withdrawals, but taxes still apply. Risks and considerations. 1. Penalties and taxes. Withdrawing from retirement accounts early can lead to a 10% penalty plus regular income taxes on the amount withdrawn. 2. Impact on retirement savings. Taking money from your retirement account means you lose out on potential growth, delaying your long-term financial goals. Chapter 11. Personal funding through life insurance loans overview. If you have a permanent life insurance policy, like whole or universal life, you can borrow against the cash value of your policy. This type of loan doesn't require a credit check and doesn't affect your ability to borrow from other sources. The loan is taken against your policy's accumulated cash value, which grows over time. Key points. 1. Loan amounts, up to the cash value of the policy, varies based on the policy. 2. Interest rates, typically 5% to 8%, depending on the insurer. 3. Repayment terms, flexible, but unpaid loans are deducted from the death benefit. 4. Approval requirements, no credit check, only sufficient cash value in the policy. How it works. The insurer will allow you to borrow up to the amount of your policy's cash value, using the policy itself as collateral. You are not required to repay the loan, but any outstanding balance will be subtracted from the death benefit your beneficiaries receive. Pros. 1. No credit check or income verification required. 2. Flexible repayment terms, and you don't have to pay back the loan if you choose not to. Cons. 1. Reduces the death benefit if the loan isn't repaid. 2. Interest continues to accrue, even if you don't make payments. Chapter 12. Grants and scholarships for personal development overview. Though typically associated with education, grants and scholarships can also provide personal funding for specific projects, personal development, or career advancement. Unlike loans, grants and scholarships don't require repayment, making them an attractive funding source for those eligible. Key points. 1. Funding amounts, $1,000 to $100,000, depending on the grant or scholarship. 2. Interest rates, none, as funds don't need to be repaid. 3. Repayment terms, none. 4. Approval requirements, varies by grant or scholarship program types educational grants, federal and private scholarships are available for educational pursuits, even for mid-career professionals looking to upskill or pivot careers. 2. Business grants. Entrepreneurs can apply for grants from the government or private organizations to start or grow a business. 3. Personal development grants. Non-profits and philanthropic organizations often provide grants for personal projects related to health, wellness, and creative endeavors. How to apply? 1. Research opportunities. Look for scholarships and grants that align with your personal or professional goals. 2. Prepare a strong application. Highlight your achievements, personal story, and how the funding will support your goals. 3. Meet deadlines. Many grants have specific application windows. 3. Plan ahead to ensure you meet all requirements. Chapter 13. Venture Capital and Angel Investors for Larger Funding Needs Overview. If you're pursuing a large-scale project, like launching a business or tech startup, venture capital, VC, or angel investors can provide substantial funding. These investors are looking for high-potential opportunities, typically in exchange for equity, ownership, in your project or business. Key points. 1. Funding amounts, $50,000 to $400,000 or more, depending on the investor. 2. Interest rates, none, but investors receive an equity stake. 3. Repayment terms, none, though investors will expect a return on their investment over time. 4. Approval requirements, strong business plan, high growth potential, networking. How venture capital works. Venture capital firms pull money from multiple investors to provide funding for startups and early-stage companies. In exchange for their investment, they take equity in the company, expecting significant returns as the company grows. Angel investors. Angel investors are typically wealthy individuals who provide early-stage funding for startups. They may offer smaller amounts than VC firms, but they also tend to take a more personal approach, often offering mentorship and connections. Securing investment. 1. Develop a solid business plan. Investors want to see a clear roadmap for growth. 2. Create a pitch deck. This presentation outlines your business idea, market opportunity, team, and financial projections. 3. Network. Attend investment conferences, pitch events, and meetups where you can connect with potential investors. Chapter 14. Family and Friends Funding Overview. Borrowing from family and friends is a common way to access personal funding, especially if you need $10,000 to $100,000 and prefer a less formal lending arrangement. While this can be a quick and flexible solution, it's important to approach these loans with clear communication to avoid damaging relationships. Key points. 1. Loan amounts, $1,000 to $100,000, depending on the relationship. 2. Interest rates, typically low or none, though it's important to agree on terms. 3. Repayment terms, flexible, but both parties should have a written agreement. 4. Approval requirements, none, beyond trust and personal relationship best practices. 1. Set clear expectations. Both parties should agree on the loan amount, repayment schedule, and any interest. 2. Put it in writing. Even if you're borrowing from close family, having a formal agreement can prevent misunderstandings. 3. Consider emotional impact. Money can strain personal relationships, so make sure both parties are comfortable with the terms. Chapter 15. Microloans for Personal Projects Overview. Microloans are small loans, typically ranging from $500 to $50,000, designed for individuals who may not qualify for traditional bank loans. These loans are often used for small business ventures but can also be applied to personal projects, especially for those with limited credit history or financial resources. Key points. 1. Loan amounts, $500 to $50,000. 2. Interest rates, 8% to 25%, depending on the lender. 3. Repayment terms, 6 months to 5 years. 4. Approval requirements, lower credit score requirements, community-based lending. How to secure a microloan. 1. Find microloan providers. Organizations like Kiva, Axiom, and Grameen America offer microloans aimed at underserved individuals. 2. Prepare an application. These lenders focus on personal stories and community impact, so craft a compelling narrative for how the funds will help you achieve your goals. 3. Consider peer-to-peer microloans. Some platforms allow individuals to lend small amounts to borrowers, creating a diverse pool of funding sources. Chapter 16. Alternative financing options. Beyond traditional loans and investment, there are several alternative ways to secure personal funding that can be more flexible or suited to specific circumstances. Key points. 1. Loan amounts varies widely depending on the option. 2. Interest rates varies depending on the method. 3. Repayment terms often flexible based on personal arrangements. 4. Approval requirements varies based on the method options. 1. Income sharing agreements, ISAs, instead of borrowing money. Some platforms offer funding in exchange for a percentage of your future income. 2. Reverse mortgage. For homeowners over 62, a reverse mortgage allows you to borrow against the equity in your home without making monthly payments. 2. Instead, the loan is repaid when you sell the house or pass away. 3. Cash advances. While cash advances on credit cards can be expensive, some fintech companies offer more affordable cash advance options based on your future income. Conclusion. Charting your path to funding success. Personal funding between $10,000 and $400,000 requires thoughtful consideration of your unique circumstances and financial goals. From traditional loans to more creative financing solutions like microloans, retirement accounts, or even venture capital, there are numerous ways to access the funds you need. Always weigh the risks and benefits of each option, ensuring that your choice aligns with your long-term financial health and personal goals. By taking the time to explore each avenue, you'll be better equipped to make informed decisions, unlocking opportunities for